hell is voting against the accountants?
Charlie Munger is Warren Buffett's right-hand man and himself an investment legend. And during the Daily Journal's 2021 annual meeting, the world had the opportunity to hear him speak. Some of the most controversial subjects he tackled, coming up.
And we will now proceed to the question period.
Welcome back. My name is Stephen Spicer, and it's my goal to help you invest smarter and build a stable lifetime income. Now, I'm going to guide you through 6 of the most interesting subjects from that meeting. Now, if you've never heard him speak, Munger tends to speak in quick, thoughtful sound bites. So from the various questions asked at different points throughout the meeting, I pulled all the parts together where he addressed each of these subjects so that you can get a much more complete picture of where he stands. Feel free to check the detailed timestamps that I put together for you if you'd rather just jump around. Okay, so the first subject deals with how investors should handle the speculative frenzy rampant in the market today.
Well, these things do happen in a market economy. You get crazy booms. Remember the dot-com boom, when every little building in Silicon Valley rented at a huge price, and a few months later, they were about a third of them were vacant. There are these periods in capitalism, and I've been around for a long time, and my policy has always been to just ride them out. And I think that's what shareholders do. In fact, what shareholders actually do is a lot of them crowd in to buying stocks on frenzy, frequently on credit, because they see that they're going up. And of course, that's a very dangerous way to invest. I think that shareholders should be more sensible and not crowd into stocks and just buy them just because they're going up and they like to gamble. And of course, Kipling once wrote a famous poem called "The Women," and the concluding line was to the effect that you should learn about women from him instead of yourself. But he says, I know you won't follow my advice.
With that backdrop, some investors are concerned about the future of value investing. And that's our second subject.
Value investing, the way I regard it, will never go out of style, because value investing, the way I conceive it, is always wanting to get more value than you pay for when you buy a stock. And that approach will never go out of style. Some people think that value investing is you chase companies which have a lot of cash and earn a lousy business or something. But I don't define that as value investing. I think all good investing is value investing. It's just that some people look for values in strong companies and some look for values in weak companies. But every value investor tries to get more value than he pays for. What is interesting is that in wealth management, a lot of people think that if they have 100 stocks, they're investing more professionally than they are if they have 4 or 5. I regard this as insanity, absolute insanity. I find it much easier to find 4 or 5 investments where I have a pretty reasonable chance of being right that they're way above average. I think it's much easier to find 5 than it is to find 100. I think the people who argue for all this diversification, by the way, I call it de-worsification, and which I copied from somebody, and I'm way more comfortable owning 2 or 3 stocks which I think I know something about and where I think I have an advantage.
Charlie Munger is not the only legendary investor who feels this way. Warren Buffett, Joel Greenblatt, Peter Lynch, Ray Dalio have all outlined data-backed reasons for this belief, the idea of investing in a select few companies that you know super well instead of scatter shooting 100. I outline all of their research-based reasons for this practice in this short video. Now, Munger went on in this meeting to outline successful value investors' strategies during periods of market euphoria.
Of course, it's hard to know what the future holds in a complex system where you can't predict a lot of things. And generally what people do is they have financial reserves, so they have some options if trouble comes, and they adapt the way Jerry has to required downsizings or required upsizings. One of the interesting things about the Daily Journal is that we made all that money in the foreclosure boom. So we were like an undertaker who suddenly got prosperous in a plague year. And it's a funny way to make money. And that happened because Jerry and I bought these little flea-bitten newspapers all over the state for just as a precaution to make sure we could serve public notice advertising wherever it arose in the state. And
One stop center.
Yes, and that turned out to be a wonderful idea, and that's one of the reasons we made all this money.
I think most people can agree with that. If you think our market is in a euphoric state, increase your reserves so that you have more ready to scoop up solid companies should the whole market come crashing down. Fair enough? As to whether or not you think the market is in a euphoric state, well, Munger, at least, seems to think so. I definitely think so. Berkshire Hathaway's balance sheet would suggest as much. Anyway, the third subject here is just a quick takeaway from the meeting that I found interesting. It came when he described the future of the oil and gas industry in the midst of this green revolution.
I think the oil and gas industry will be here for a long, long time. As a matter of fact, it'll be here for a long, long time if we stop using much hydrocarbons in transportation. The hydrocarbons are also needed as chemical feedstocks, and I don't think that hydrocarbons are going. I'm not saying that oil and gas is going to be a wonderful business, but I don't think it's going away, and I don't think it's like the newspaper business.
Well, there you go. Now, this is where Munger starts to get a bit more fired up. This fourth subject has to do with SPACs, the so-called special purpose acquisition companies that have kind of come out of nowhere. They're also sometimes called blank check companies. Yeah, any guesses as to how Munger feels about these? Well, he did not disappoint with his scathing and delightfully quotable quips. Check it out.
Well, I don't participate at all, and I think the world would be better off without them. I think this kind of crazy speculation in enterprises not even found or picked out yet is a sign of an irritating bubble. It's just that the investment banking profession will sell shit as long as shit can be sold. I think it must end badly, but I don't know when.
I, for one, have thought it seems oddly reminiscent of the takeover craze during the 1980s, and that didn't end super well. Now, I'd be lying if I said I wasn't interested to see how this all plays out. After all, it's because of the chaos that stems from this kind of financial wizardry, you know, it's always just one thing after another, that I have a career, that savvy people seek a better way. Anyway, time will tell. But it's clear that Munger, at least, is forecasting their inevitable demise. All right, now for this next one. I'm sure it comes as no surprise where Munger, and Buffett for that matter, stand on the subject of Bitcoin. But I imagine, given their enviable track record, that even the hardcore hodler is at least curious what they have to say about it.
I do think that a properly run bank is a great contributor to civilization, and that the central banks of the world like controlling their own banking system and their own money supplies. So I don't think Bitcoin is going to end up the medium of exchange for the world. It's too volatile to serve well as a medium of exchange. And it's really kind of an artificial substitute for gold. And since I never buy any gold, I never buy any Bitcoin. And I recommend that other people follow my practice. Bitcoin reminds me of what Oscar Wilde said about fox hunting. He said it was the pursuit of the uneatable by the unspeakable.
Now, before you're quick to judge Munger and Buffett as being old and out of touch, if you look back to speeches given by them in the late 1990s, they had a similarly pessimistic outlook as to the future of the dot-com stocks. At that point, many did the same. Many just brushed them off as being dinosaurs, unable to comprehend the new paradigm. To which Buffett famously retorted, "It's only when the tide goes out that you learn who's been swimming naked." Only time will tell whether he and Munger are on the right side of this particular issue. But Munger's response to the question about whether the Daily Journal would be following Tesla into Bitcoin should come as no surprise.
No, we will not be following Tesla into Bitcoin.
Yeah, could have seen that coming. But he didn't let up. When asked about which valuation he thought was crazier, Bitcoin at $50,000 or Tesla's fully diluted enterprise value of $1 trillion, he used that opportunity to twist his knife just a little bit more.
Well, I have the same difficulty that Samuel Johnson once had when he got a similar question. And he said, I can't decide the order of precedency between a flea and a louse. And I feel the same way about those choices. I don't know which is worse.
All right. Now, with this last subject, Munger seemed to keep making his way back to it throughout his entire questioning period. It's commission-free brokerage platforms like Robinhood. In short, he's not a fan. His mudslinging started when asked about the recent GameStop fiasco. Here's what he said.
That's the kind of thing that can happen when you get a whole lot of people who are using liquid stock markets to gamble the way they would in betting on racehorses. And that's what we have going in the stock market. And the frenzy is fed by people who are getting commissions and other revenues out of this new bunch of gamblers. And of course, when things get extreme, you have things like that short squeeze. It's not generally noticed by the public, but clearinghouses clear all these trades. And when things get as crazy as they were in the event you're talking about, there are threats of clearinghouse failure. So it gets very dangerous. And it's really stupid to have a culture which encourages as much gambling in stocks by people who have the mindset of racetrack bettors. And of course it's going to create trouble, as it did. And I have a very simple idea on this subject. I think you should try and make your money in this world by selling other people things that are good for them. And if you're selling them gambling services where you rake profits off the top, like many of these new brokers who specialize in luring the gamblers in, I think it's a dirty way to make money, and I think that we're crazy to allow it.
Now, there was a lot there, and he gets even more vicious later, but I want to unpack that gambling house analogy real quick. Now, I've entered a poker tournament at a casino one time. $100 entry fee, $2,000 first prize, $1,000 second prize. There may have been other prizes, but who really cares? That was fun. I got second, by the way. Other guy sucked out on the river. I was right to push them all in. I was ahead. I digress. Sorry. Anyway, everybody knows that even though the casino, isn't charging a commission per se for you to enter their tournament or taking a portion of your entry fee, you know, they're not directly taking $10 of that $100 I paid in order to play. So they could honestly say that 100% of my contribution here is going into the prize pool, right? Kind of commission free. Instead, they're just going to take a cut of that total prize pool, say 10%. Effectively, it's all the same to me and the other players. We're eating that fee one way or another, whether it's right up front directly or kind of behind the scenes, maybe in a way that's not quite so out in the open. I think this is one of Munger's main beefs with the model. A lot of individual investors don't really understand where the money is being made. He's right, it's not entirely free. And ultimately that cost does still find its way back to the individual investor. Now, this happens with these firms in the way of a spread. That is the difference between what a buyer and a seller pay for a share of stock or an option. The wider the spread, the more the middlemen are making, right? Okay, if I sold you this pen and we're in the same room and we just exchanged the pen for $1, it's that easy. There's no spread. But if we use a third party to facilitate that transaction, say I list it on eBay, for example, they're gonna rightfully want to cut, let's say 5% of that transaction. So although you pay $1 for this pen, I only receive 95 cents. I get 95 cents for selling it. Fair enough? Now, financial markets are a little different in that we accept that they're constantly moving around. So it's a lot harder to notice the exact difference in that spread. If you could buy the pen for $1 one day and $2 the next, and at the same time you could sell the pen for 50 cents on one day or $1.75 the next, if the prices on both ends are regularly moving around in that range, it can be hard to know exactly what the best price you could get actually is. This makes it easier for the zero commission brokers to have wider and wider spreads without people really noticing. Where before the broker's mandate was kind of to get you the best deal, now they'll sell the order flow to the highest bidder, even if that means a wider spread. In other words, probably not the best price for you.
Well, commission-free trading is a very good candidate for that if you want to emphasize disgusting lies. Commission-free trading is not free. Robinhood trades are not free. When you pay for order flow, you're probably charging your customers more and pretending to be free. It's a very dishonorable, low-grade way to talk. And nobody should believe that Robinhood's trades are free.
Now, how big of a difference does that actually make? Well, the Wall Street Journal gave an example last year based on SEC filings, where for an order of 100 shares of Apple, Schwab would be paid around 9 cents and TD Ameritrade around 16 cents by the market maker, another middleman, for the order. Robinhood, on the other hand, was paid around $5.20. That difference is ultimately made up for by you via the spread where the market maker fills your order. So $5.20 compared to 16 cents compared to when you could make trades before for $5 per trade, $5 commission on most brokerage platforms. Maybe this wasn't as liberating as we've been sold. Now, there's a lot more to this in that $5.20 is just one isolated example of a highly traded, high volume stock. The discrepancy could be worse for stocks with lower volume, those that aren't as popular. But I think that might be a big part of the problem. Now it's not as straightforward what exactly it's costing you. Regardless, free is such a compelling concept that the industry just seems to be moving that way anyway now, moving their profit-generating activities to a more back-of-the-house style operation. They've all got to compete with the Robinhoods of the world now. If you're curious about your broker, just Google their name with 606 report, and you'll be able to see exactly how much they were paid by the various market makers. And if you've been watching these reports for a while now, you'll see more and more of them going in that direction. And when you notice the same market makers coming up each month as purchasing the lion's share of all the outstanding order flows, kind of makes you wonder if perhaps there are some greater implications here. But you didn't come here to hear me pontificate, you came for Munger, so maybe we'll explore that another time. But maybe it is more something like that deep down that's really ruffling his feathers. For example, when asked where he felt the wretched excess in the market is currently most egregious,
Well, it's most egregious in the momentum trading by novice investors lured in by new types of brokerage operation like Robinhood. And I think all of this activity is regrettable. I think civilization would do better without it.
The man does not mince words. It would seem that what the masses have viewed as liberating, this proliferation of stock market investing, Munger views as dangerous, that most individuals should not be attempting to invest in individual stocks. And I know Buffett has shared similar views on that subject. In that regard, it does remind me of the late 90s, how one of the major contributors to the rapid inflation of the dot-com bubble was the advent of the discount brokerage firm. You know, where commissions on trades used to cost $100 in the 70s were now only like $10. Because of that, you'd see headlines in the 90s like, good news, you're going to be a millionaire. Bad news, so's everyone else. The stock market game was so easy now, and well, everyone flooded in, and then, well, you know what happened. And if you don't, you're super young, and we should probably study some history on this channel. Anyway, here we are now, today, 2021, with even more people flooding into the market.
You'll remember that when the first big bubble came, which was the South Sea bubble in England back in the 1700s, it created such havoc eventually when it blew up that England didn't allow hardly any public trading in securities of any companies for decades thereafter. It just created the most unholy mess. So human greed and the aggression of the brokerage community creates these bubbles from time to time. And I think wise people just stay out of them.
Well, there you go. Like I said, in short, Munger is no fan of Robinhood. Now, I know I'm not as wise as Charlie Munger. He probably sees some things I don't yet. But on the whole, I think the proliferation of stock investing is a good thing. It does give way to speculation and gambling, like he talks about. You can see it all around you. But I guess I would view that as the responsibility of the individual to keep in check, as opposed to the system. So hopefully, as we educate people here on this channel on how to prosperously invest, that'll become less of a problem. Now, that being said, I can definitely see a few threads that have never ever been pulled before that are being pulled now and really fast. So I don't claim to know how it'll all play out, but we never do. And that's the beauty of what we do in finding the best ways to build out our portfolios so that they're prepared no matter what happens. I'm going to leave you with what I thought were the quirkier moments of the meeting. But first, thank you so much for watching. If I could hit your like button, I would. All right, you take care. Here's Munger.
You can understand why Warren got disenchanted with Wells Fargo. I think I'm a little more lenient. I expect less out of bankers than he does.
Charlie, probably the most popular question here, it's probably too many shareholders, but they would like to know the books that you're currently reading and books that you recommend.
I think I'll skip that one. Go on. What's all this list of directors for?
Just to let people know who the directors are.
Oh, the directors are Jerry Salzman, Peter Kaufman,